Welcome everybody to our August 13th webinar hosted by ISM New Jersey. A huge welcome to our chapter members from New Jersey, Denver, Nevada, Houston, Dallas, Buffalo, and now Eastern Virginia. Just a reminder, please submit your questions using the Q&A tab. Our speaker for today is Tom Bokowy, Senior Partner at Cost and Capital. Tom has over 20 years of experience in management consulting and has led supply chain projects for clients in the automotive, hospitality, industrial, telecom, finance, white goods, consumer products, process and transportation industries. He is a certified trainer for General Motors, Ingersoll Rand, Tyco Electronics, and others. Tom has delivered trainings to over 4,000 supply chain professionals on 5 continents on the following topics: negotiations, benchmarking, supplier finance, commodity strategy, value engineering, risk management, activity-based costing, and value chain optimization. Please give Tom a warm welcome.
All right, hopefully everybody can hear me. As Kathy said, and thank you for the introduction, my name is Tom Bokowy. One of the things I'm going to be going through today is obviously a lot of people are dealing with the fallout from COVID, quarantine, a lot of business impacts and slowdowns. So one of the things we really want to try to focus on, and what this is going to be sort of a relatively, it's a small excerpt from our overall risk identification and mitigation training. But what I wanted to do is share with everybody some of the different approaches that there are for identifying risk in the supply chain. This works whether it's for a manufacturing company that's giving you products, service companies, things like that. A lot of the financial analysis is going to be the same. So the same reasons that put companies into financial distress is going to be very similar whether you're a manufacturing company or whether you're a service company. So what this is this training program really goes through some more of the proactive ways of identifying the training. What I would like to do, as Kathy kind of gave an intro for who I am, spend a lot of time with our clients trying to identify supplier financial risk and really try to get ahead of that curve. And so what I would like to encourage everyone to do is I've got my contact information on there, my email address and my phone number. That's my personal number. Always love to hear from everybody. Love to see if you're trying to use some of these tools, what's working, what maybe didn't work as expected from the training. So feel free to reach out to me anytime. I always enjoy that and love to share my insights with anybody and hope I can help. So when we talk about risk identification, this is really the first step in the process of risk management with your supply chain. Risk identification is just that. It's trying to identify what are some of the potential causes. So this is really looking down the road to see, hey, is this a supplier that has some signals or some signs that maybe I can be aware of, that I can identify potential risks before they become problems? And that's really what we start looking at, is more of a proactive approach to doing this. I know a lot of people have risk management programs. A lot of people use tools, for example, like the Dun & Bradstreet risk assessment tool. And I'm going to want to showcase how this is a little bit different than those. Those are great tools, and we have clients that use them as well. And this approach is going to be a little different than that. And what we're trying to do is look at more of a predictive approach to risk management as opposed to reactive. So the difference is really, how am I examining this? How am I trying to identify risk in the supply chain? So got kind of the example here of somebody taking their blood pressure. So a predictive approach is looking at the signs before there's actually trouble coming. So when we're looking at a supplier, we want to see, hey, what are some of the things that could be happening that can trigger some kind of a default or some kind of supplier stress? So that's where we look at the debt and working capital requirements that they have. We look at what are the changes or what are the anticipated changes to the revenue or cash flow. A lot of times when you have a supplier that has debt, they have specific credit covenants with rules. And essentially, as soon as you violate those rules, that could trigger a financial distress scenario. And so this is more of a forward-looking model. So again, if kind of using the hard health here, we compare that with more of what I would call a reactive model. So the reactive model, and this is like the tools like the DMB supplier stress tool or supplier health tool. These are more looking at what are some of the signals after you already have trouble. What are some of the things, for example, like missing payments or slow paying bills? So this is pretty much once the supplier has already started to experience some financial stress, these are the symptoms of essentially what they're doing it. So this approach is a much more high energy, high effort approach. The thing that I like about more of the reactive is that it's relatively easy to do. You know, I kind of say that's a little bit more like the shotgun approach, right? I can survey 500, 1,000 of my suppliers using kind of a service like a Dun & Bradstreet or something like that. This approach is really more diving into the financials, especially with a lot of your private suppliers as well, diving into those financials so that you know the right questions to ask and you can identify some of the triggers that could put them into a financial distress scenario. So that said, I just want to give a couple comments of this presentation. As I said, it's an excerpt of typically what is anywhere from a half day to a full day training that we do typically in person. I'm going to go through a couple of the examples of some of the key things to look for, how to calculate them. But I understand Kathy had sent out an email that has a link to the whole presentation. There's probably about twice as many slides that are in the appendix. And that's going to cover information like the additional financial metrics. It has some of the templates and some of the scenarios of how to run through things. We're not going to have the time to go through that today, but just know that that's in the presentation. And again, I'm very happy to answer any questions that you have. Also, as Kathy said, during this, if you have questions on the material, I love to get some feedback from everybody during the slides. So if you have a question, put it in that Q&A section, and I'll try to respond to it while we're going through this. So yeah, so that said, let's kind of get through. When we look at suppliers, we want to identify what are the types of ways that they go into bankruptcy or financial distress. So we typically have three ways that suppliers can get into a financially distressed scenario. You know, everybody thinks bankruptcy and they think, oh, you know, companies just can't compete and, you know, their costs are too high and they're going to go bankrupt. And that is definitely one of the ways that a supplier can go into bankruptcy. But what we're also going to focus on are what are some of the ones that can be a surprise or can kind of catch you off guard. One of the big ones, and we're going to see that probably more and more, is anytime we have a economic calamity, whether it's back when we had the Great Recession back in 2009, or whether it's the response, the global response and the impact that it's having on production and volumes and things like that because of COVID. The risk event that we have is that if I have a company that has debt, and some of your suppliers are going to be highly leveraged or have a high amount of debt, and that could be, you can really have two forms of debt there. You've got your long-term debt, which is essentially going out and getting long-term bonds or some sort of bank debt that has a principal maturity. When you're thinking about this, think about your own home mortgage. You have a big amount of debt, you have payments that you have to make. But one of the things that we have to watch out for our suppliers here is a lot of times they're just going to expect that when they're done with a particular maturity of debt, that they're just going to be able to roll that over and say, okay, this loan is $5 billion and it comes due in January, and they would just expect to go back out to the financial markets and say, okay, we're going to roll over this debt. Company's operating about the same as it was when we first got into this agreement, and now what we really need to do is roll over that debt and essentially get a new mortgage or a new series of funding for the company. So part of what we want to look at is saying, okay, when is that debt coming due? So if your supplier is a public supplier, which means that they're going to be reporting their financials to the SEC, so think, a publicly traded company on the NASDAQ or New York Stock Exchange, something like that, they're going to have to publish their balance sheet, and a lot of that is going to include their long-term debt. But then if you actually read the annual reports, it'll tell you when that debt is going to mature. So you can see, hey, I've got a big principal payment that I need to make in 6 months, 12 months, 2 years. Again, it doesn't mean they're not going to be able to make that payment, but it means that there needs to be liquidity in the market. One of the differences this market is that, regardless of your view on politics and the government, one of the things that's happening is that the Fed has definitely pumped a lot of liquidity into the market. The Fed is buying up bonds from public companies, those types of things. So there's a lot of liquidity in the market. In 2009, a lot of the financial markets seized up. So a lot of times companies were expecting to go back out to the markets and refinance the debt that they had. Those lending options were not available. And they were definitely not available at the terms that would work for companies. So the risk event that we have here is a debt maturity, or the other is violation of a covenant. So if I've got two forms of debt, I've got the big long-term debt, but then I also have credit revolvers or some way that I'm financing sort of my short-term cash. And a lot of time, those credit revolvers are going to have restrictive covenants in it. It might be something that you need to have a certain amount of interest coverage. So it'll say that, hey, if your interest payment is 100, you need to be generating 500 in cash every quarter, every year, in order to not violate that covenant. And that's kind of what we show here is we have the EBITDA, which is essentially, that's earnings before interest, taxes, depreciation, and amortization. What that means is on a basis, what is the ability of that company to generate cash, whether it's by the quarter, for the year. You divide that by the interest payments that they have to make. So if I'm making 5 times the amount of cash as my interest payment, I would have a 5x interest coverage ratio. Now, depending on who they got their money from and how strong the company was at the time, they might have a covenant that says interest coverage has to be 2x, 5x, 10x, whatever it is. So if the company ever drops below that amount, the bank can stop lending them that money. They can cut off the access that they would have to that capital. What that means is if I'm a company, I can have these credit covenants out there, and if I violate them, I'm not going to have access to the cash I need to run my business. Now, we're going to go into how do we identify this, but that's sort of the first event, is we would say a debt maturity or violating a coverage ratio. Hopefully that's somewhat clear, but again, it's pretty much just saying that the company has to be within the operating bounds of their credit agreement. So the next, and this is also going to be a big impact with COVID, is the working capital impacts on our supplier. So a lot of times with our suppliers, they're going to have payment terms. So we buy something from the supplier, we pay them in 45 days, 90 days, etc. Well, what ended up happening during COVID is that we had some industries, like the automotive industry in the US, pretty much went to zero orders for a certain amount of time. So you have all these suppliers that had been providing orders, having cash in the system, and then they would wait 45 days, 90 days till they got that cash. So when the automotive supplier companies stopped producing cars, well, they also stopped ordering parts from the suppliers. So you think, okay, well, that's bad. From a cash perspective, that's actually not bad from a supplier in the immediate term for the first couple months, because when that last order went out, they typically have 45 to 90 days of when that cash is going to hit their account. So right off the bat, when the volume dips down, what you're going to see is that they're still generating that cash. They're generating that cash that is owed to them from the orders that they had for the last 1 to 2 months. The problem we have now is, now that volume went way down and was at zero for a lot of these suppliers for anywhere up to about 1 to 2 months, and some haven't even rebounded back to 100%. Well, as they get that spike in orders, they have to pay for the labor for that. They have to pay for the materials for that. So you have this big spike in orders, but you're going to have to wait now 45, 90 days before you get cash again. So this is kind of that whipsaw effect that we can see with the suppliers. And this is a fairly dramatic change in volumes on the industry. So what we notice here is that if I'm going to be a supplier and I'm going to survive that, I need the working capital. So the working capital is essentially the cash that I have on hand in my company, my inventory, and I need to have enough that I can produce this product, pay my employees, pay my suppliers, up until I start getting that money coming back from my customers. So a couple things that we really want to look out here is, what industries is your supplier exposed to? Are those industries being impacted by big volume changes? And we're going to go through a few of those as well. So when we think about supplier distress, these are sort of the two cases that can sneak up on you. These are definitely the ones that you can get caught off guard. So a supplier that's going to violate a credit covenant or a debt maturity that they're not able to refinance, or sort of this whipsaw effect that you get from sort of a tidal wave of volume when it dips down like that and comes back up. The third, and this is typically more of what everybody thinks of when they think about bankruptcy or they think about supplier distress. We think about suppliers that have an unsustainable business model. If this were a classroom session, I would ask everybody what are some typical industries like that. But I think you probably know a few. It's no secret that brick and mortar retail not only have they been struggling against some of the larger big box stores, but they also struggle definitely from e-commerce. You combine that with the fact that for months people weren't in parts of the country weren't even allowed to go out and shop. That's going to be an industry that has a natural unsustainable business model. And so these are the ones that, again, they don't sneak up on you. It's not a secret that this is a struggling industry. So typically what we're able to find out in these types of cases, though, is that we're able to have a little bit more notice. We can see some of what's going to happen beforehand, and what you want to look at is, do they have issues of declining revenue? Do they have relatively poor margins? Do they have relatively high overhead for the company? So those are a couple of the metrics to look at there. But again, these are not the ones that are going to sneak up on anybody. If it's a public company and they're in a tough industry, and if they are sitting in a tough time, you're going to see the valuation of the company. So their stock price essentially go down over time as well. Because again, it's not a surprise. It's something that you can definitely plan on and look at. So when we look at some of the changes in volumes, and this is a combination of both market factors as well as COVID, you can kind of see the change in year-over-year volume for a couple industries. Some of the big ones, automotive, 2002 or 2020 compared to 2019, down about 22%. There's already been several supplier bankruptcies. In the aerospace industry, again, not a lot of people are flying, but even before that, Boeing was having quite a few issues. So you have about a 50% decline in the aerospace industry. And again, that cascades down to the suppliers as well. So if you have suppliers that are a big supplier on the 737 program and Boeing stops producing that for a year and a half, that's going to have a big impact to them, both on the declining volumes, but then as volumes spike back up again. Hospitality, again, with people staying home, not traveling for work. I'm definitely in that crew. Used to probably travel 40 to 50 weeks a year, and I think I've traveled 2 weeks in maybe the past 5 months. So you look at who gets hurt from there. Hertz, they declared their bankruptcy. The cruise line industry is definitely under stress. The hotels industry under stress. Wirecard, that's a financial company that does a lot of the bank payments. Granted, that was a potential embezzling from one of the people in the companies. You can't use financial analysis to identify those types of risks, but that was kind of what's happening there. Retail, and again, we should probably break out retail from online versus brick and mortar, and also different industries in retail, right? So you've got online that's actually gone up, you've got grocery brick and mortar that's gone up, but then you have more of your consumer brick and mortar that's gone down much more than that 12%. You see that in the bankruptcies, and there's been so many more since I even put this slide together, but JCPenney's, Brooks Brothers, they declared bankruptcy as well. The oil and gas industry, so this is a volume change, but you look at revenue change. Not only are they producing less oil and gas, but the price that they're selling that oil and gas for is even lower. So you see a lot of companies that supply to that industry being impacted with bankruptcies like Chesapeake Energy, High Crush, Frac Sand. So a lot of these highly leveraged oil and gas companies, particularly a lot of your shale plays, fracking companies, those are the ones that have been particularly hit hard by this as well. So here's just kind of a little summary of what people are talking about on the public markets. So these are all public companies, but what I appreciate with this is how important public companies are realizing that their cash position is very important to them. So you've got the U.S. Steel CEO, cash is not just king, it's queen, prince, princess, the whole royal court. We have quite a few of our clients that are both suppliers to U.S. Steel and the steel industry. And yeah, they're definitely noticing the impacts both of volume, cash management, those types of things as well. PPG's CFO, with regard to receivables, we did increase our bad debt reserve. So what that's showing you is that public companies, and again, they have to share this information with their investors. They're public companies, so they're required to. But the fact that they say, look, we've got customers that are out there. We know they're going to declare bankruptcy. We know we're going to have receivables, money that we're expecting, that we're not going to get paid. Then you've got Cleveland-Cliffs, another natural resources company. We thought it was best to raise some additional capital. And then also with Granger, we proactively tapped $1 billion of the $1.25 billion revolving credit facility. So what's that telling us? And I kind of use this, you can kind of use the example. I've got a friend who, one of my neighbors that lives next to me, he ended up losing his job, but we were talking about it. He's like, well, I'm not too worried about it. He's like, we've got plenty of equity built up in the house, so we'll tap in a home equity line of credit and it won't be a problem. Well, the problem is now he can't prove income because he's not working. Companies are the exact same way. Yes, you might have all of this equity built up, but if you can't show that you're viable, if a bank's not willing to lend you that money, then you really don't have access to that cash. You might have all this equity sitting here, but you don't have that cash available. So one of the things that we notice is that a lot of the companies that are out there, if they have revolving credit facilities, or if they have the ability to tap those to generate cash, most of them have been running it up. Now, granted, they're going to pay interest on that. It's usually not a big amount, but they would rather have the cash in their own pocket than the promise of the cash. Because that's the other thing too. If I'm going to violate a credit covenant, that just means the bank can't lend me any more money. So I might have $1 billion of credit out there. If I violate my covenant, zero is going to be available to me. But if I pull that out and I start paying interest on it, the bank can't just pull that back even if I violate a covenant. So you see a lot of these companies that keep tapping the credit revolvers that they do have. And that's also a sign of, one, it's good because what it's showing is that they're going out and they're getting that cash now so that they won't run into a cash problem. But it also shows that they're looking at the horizon as well, and they're seeing trouble out there too. So one of the things, when you're doing a financial analysis of these companies, there's not one number that's going to excuse me, that's going to put a supplier into a financial risk. It's typically a combination of them. So we have 8 that we see as really being the key ones that if you're going to analyze a company, these are the 8 you really need to kind of sink your teeth into and identify. So the first is kind of that leverage ratio, or that's what we call the long-term debt divided by the equity of the company. So what long-term debt is just that. It's the debt I have long-term. It's that house mortgage type of the debt. And the equity is just the value of the company. So I've got all of my assets minus my liabilities. What's left over is equity. So a lot of times companies will say, hey, maybe I'm not highly leveraged. Maybe I don't have a lot of debt out there. So that means they've got a lot of equity, just like your home. They have a lot of equity that they can tap for cash if they need it. But again, you can also have companies that are very highly leveraged that are also very successful. As long as they just keep generating cash, you can have companies that actually have negative equity because they're so leveraged. That alone does not necessarily mean that they're going to be in financial distress. So it's really a combination of metrics. The next is that long-term debt divided by their EBITDA. So as we talked about, EBITDA is really your ability to generate cash as a company. So it's really saying, hey, what's my debt divided by how much cash I'm generating quarter over quarter, year over year. So that really gives you kind of a feel for their ability to service that debt based on the cash that they're creating. And that's when we start looking forward and we say, hey, this is a company, they're going to have a big dip in revenue, which means that they're going to generate less and less cash. That's when you start to see, okay, maybe these two things tied together, they have a lot of debt relative to equity, and they're not generating a lot of cash relative to equity. Those two together are a lot more meaningful than just one of those metrics by itself. The third one, long-term debt due in 1 year. And again, this is going to be something that you can pull, and we're going to show an example, pull directly from the balance sheet. Now, what long-term debt due in 1 year means is exactly that. How much of my debt, so how much of my principal payment am I going to have to make within the next 12 months? So that means I either have to fund that from cash on hand, or I have to fund that by going out and getting another loan in order to pay off that loan, which a lot of companies do as well. But again, the risky part there is this is where you want to have your conversations with both your public and your private suppliers. Hey, you've got a big debt that's coming due. What's the bank saying? Does the bank have liquidity to loan? Are you all set to get that? And maybe even, are you going to pull ahead that refinancing of this so that you know that you have the cash paid and you can push that payment out to the future as opposed to having it now? Because that's the other key thing too. You might think that it's no big deal to roll over a relatively small piece of debt, but if the financial market seize up, if the bank is not willing to lend money, or if the public markets are not willing to lend money, then that cash is not going to be available out there. And again, that was the big impact in 2009. That's why you had Lehman and the other ones also essentially seize up. Then you have the EBITDA over interest, which is really your interest coverage ratio. So what that is telling you, again, I kind of explained that earlier, I have to generate a certain amount of cash relative to my interest payments. So even if I have a longer term debt that's out there, that's servicing, that's my credit facility, if all of a sudden I'm not generating enough cash to service my interest, at least at the multiple that the bank wants me to, they can close up access to that. So that's also when you're going to have a supplier go into some kind of a financial distress scenario. Current assets over current liabilities. Anybody that's taken Accounting 101, that's just going to be your current ratio. That's just saying my current assets are anything of value that I should be able to turn into cash within 12 months. And my current liabilities are anything that I have to pay in 12 months. So again, you definitely almost always want this to be above 1, but to be safe, because some of your assets are a lot more difficult to turn into cash. For example, inventory. You like to think that inventory is going to be turned into cash, but a lot of companies have to write down inventory. So when we look at kind of a safe number, anything above 1.25 puts you in the relatively safe zone. Anything above 2.5, you should be, completely green and not having an issue there. Anything below that means, hey, we really need to keep an eye on where the cash is coming from to pay for those liabilities that are coming due. This next one is the next 12 months cash required divided by the cash and credit available. This one's a little bit more difficult. This is actually looking at projecting what their finances are going to look like. When we do these reports for our clients, that's something that we develop. We kind of model what the cash flow is going to look like. You can do that. We'll have some of the templates in the additional material. But again, this is saying, hey, if orders go down 50%, 25%, how much cash will you be able to create versus how much are you going to burn through? So this is really going to be a key situation for companies that are going to be burning through more cash than they're generating. So this is typically going to be a big issue for companies that are planned to have a negative EBITDA for the next 12 months. And again, you typically see that in very big contractions in markets, which we are in that kind of a stage right now. So you want to just make sure, do you have the cash and credit on hand in order to weather that for the next 12 months? Then you have cash and credit as a percentage of revenue. And again, what this is looking at is how much cash do you have on your books versus how much working capital or access to a credit revolver do you have divided by the revenue that you have in the company. So anything less than 10%, and again, a little bit depends on the industry. This one's a little bit less of a hard and fast rule depending on the industry, but anything less than 10%, and you'll be concerned. You want to understand that, hey, let's track how they're doing. Are they generating cash quarter over quarter? And then your EBITDA margin. So this is essentially your cash margin. Is the company still making cash from the operations that they do have? So if they're not, that's a real red flag because that means that they're burning through money. If they're not making enough, that could still be bad because even though you're making cash, you might not be making enough to service those interest payments or to not violate your covenants. So those are what we kind of see as the big 8. Again, any one of those in a vacuum or any one of those by themselves isn't going to give you anything definitive in terms of, yes, this company's in trouble or not. But what you start to see is when we put them together, that's when you start to see trends. So the example, and again, I'm not too worried about the information on the table. This is all public information, but this is some work that we did back in 2009. And you can see, you know, a little splash of red or yellow or orange isn't too bad. But when you see a wide swath of it, you know, just looking at it from a top-down perspective and saying, hey, based on these metrics, this particular supplier's in red on a lot of the metrics. That's just a good visual way to just say, okay, who's really bad? And if I've got a company that's relatively good, if there's one factor that's bad, I can start to say, okay, let's drill into that. Is it maybe they're highly leveraged? Well, I just need to make sure that they're generating cash if they're highly leveraged. So again, one red metric alone is not going to kill a company, but when you start to see, you know, like that top example, when you start to see red across the board, it's just like a dashboard, and it lets you know, hey, this is a supplier that we need to really be at risk of. The next is, these don't really operate, again, on their own, but in tandem, some of those metrics are really interesting. So you have sort of that most recent debt divided by debt to equity. So how much leverage that they have relative to their cash flow relative to the revenue. So again, is this a company that's burning through cash? If they're burning through cash, are they going to be able to go out to the financial markets? If I'm already highly leveraged, it's going to be much more difficult for me to go out and get more debt. You know, think second, third mortgage on your house, as opposed to saying, hey, I've got a house, I've only got a mortgage that's maybe 10% of the value of the house. I should be able to get more money on that. Doesn't mean that you will, but it means likely you should be able to find some financing for that. So again, that's why we kind of look at those two by two. You have corners where, yeah, you're green, you don't need to worry about it. You're not highly leveraged, you're generating cash. That's the happy place to be. But when you're highly leveraged and you're burning through cash, that's definitely the danger zone. And obviously you can kind of see the color coding from that. The other is kind of looking at that cash on hand divided by what the model is saying your cash flow is going to burn through. So again, when we typically do this, we'll model out how much cash we expect them to burn through and then say, okay, you're going to burn through X amount of cash, how much cash do you have on hand? So it's not just how much you're burning through, but it's also how much you have. So again, anytime you're burning through cash, that's always bad. But if I'm burning through cash, at least I want to make sure I've got a lot that's saved up. So how do we do it? Again, whether you've got a public supplier or a private supplier, they're going to have three financial statements. They're going to have a profit and loss, they're going to have a balance sheet, and they're going to have a cash flow analysis. So there's a couple quick calculations that you can do from this balance sheet. One of the things that we like to do is we talk about that current portion of long-term debt. So how do we find that? So in this example here, we have a supplier, so it says long-term debt due within 1 year. So that is your long-term debt due in 1 year. And it should be a line item spelled out on every balance sheet. They're pretty standard. In the US and Europe, they should almost look exactly like that. In some of the Asian markets, they might have different names, but in general, those ones are relatively easy to pull out. So that's the amount of debt that I have. That's the principal that I have to pay back within 12 months. But then I want to divide that by my total amount of debt. So my total amount of debt is going to be that debt, plus it's going to be on the balance sheet under liabilities, my long-term debt. So you put those two together, and that's my current portion of debt compared to my total debt. So as I said, you can kind of see how these numbers are populated and how they're calculated, and then that will give you essentially the ratio. So in this particular one, I would calculate 21.6% of my debt is going to be due in the next 12 years. I would put that as, I would at least be concerned. I mean, this is a significant portion. I want to make sure, are they going to have access to this kind of financing? Are they going to be able to pay this off? And again, relatively easy calculation. It's just a trick of kind of finding it from that balance sheet. And as I said, in the appendix, I've got lots of examples to go through the other ones. We're just not going to go through them all today, but have the same sort of math and the animation to pull it through as well. So this one gets a little bit trickier. This is the amount of cash and credit that a supplier has available. Typically, you're not going to have a supplier just tell you this information, even if they're a public. Well, a public supplier is not required to put this information. It doesn't show up on the balance sheet. It doesn't necessarily show up anywhere else, but you have to go and read through the quarterly and annual reports. And what they will typically tell you is, and especially in an environment we're at now, where everybody has a concern about cash and liquidity, you're much more likely to have them post in their own analyst reports. And again, anybody can pull these up. They're all publicly available. You go to the company's website and they're able to get it. But typically what they'll say is that we've got a certain amount of cash on hand, which you can get from the balance sheet. And then they'll talk about their different credit revolvers that they have. They might be at different interest payments. They might be at different terms. They might be at different amounts. So what you see here is that you'll see that they have a credit revolver for 490,000, and then they'll tell you we used up 99, or it's actually 99 million. We used up 99 million of it, 92 euros of it, and 180 million of it. So what they're saying is I've got this much credit available to me. So it's kind of like having a credit card and your credit card limit. You might have $20,000 balance available credit on your credit card, but if you've run it up to $19,000, you've only got $1,000 left of that credit revolver. So that's what we want to say. It's not just how big is your credit revolver, but how much is that unused portion of it. So in this case, you can see that, yeah, they've got a certain amount of cash, but they only have $81 million available on their essentially $500 million credit revolver. So from that, you can kind of see that their cash and credit divided by their annual revenue, in that case would be 8.6%. So again, this was a supplier that was a red flag supplier as well. And again, makes sense. They don't have a lot of credit available. They've used up a lot of the credit that they do have available, and the cash and credit that they need is less than 10%, or that they have is less than 10%. So again, these would be the kinds of things that would make me nervous. These are the kinds of questions I want to be having with my supplier. So the key thing, a lot of people are like, well, that's great for my public suppliers, but it's the private suppliers that I'm worried about. And that's true. Your private suppliers are typically going to be your bigger surprises here. What I would say for this is any supplier that's a decent negotiator, or any supplier that's good, if you ask to see their financials, their first response should be no. If they're just giving that over to you, I mean, they shouldn't, because obviously from a purchasing perspective or from a supply chain perspective, they're handing over information to you that typically they don't want to necessarily share. But it's one of those things. Never miss an opportunity to leverage a crisis. In this type of environment, it's very easy to say, look, our board of directors or our head of supply chain said, if we're not able to do a financial review of our suppliers, we have to put you in a at-risk category. So the whole approach to this is say, look, I want to see your P&L, I want to see your balance sheet, I want to see your cash flow statement, and I want to know how much, I want to know what your credit, what your credit covenants are, and I want to know how big your credit revolver is. These are the things that you need to know in order to apply these analyses to them. Now, as I said, even when we do this for our clients, I would say we typically get about an 80 to 85% response rate from private suppliers. At a certain point, there are suppliers that will completely dig their heels in and say, no, I won't do it. But the vast majority do. But again, as with anything else you're asking for, this becomes part of a negotiation. Part of it is like, well, what are the consequences? Hey, you need to get it signed off by the CFO that no, you won't share this. Or you're going to be prohibited from any new business if you won't share this. Or we will default you to a red status if you won't share this information. A lot of times you can also get them, if they don't want to share their financials, you'll get them to at least share what those metrics are. Say, I need to know your leverage ratio, I need to know your coverage ratio, I need to know your EBITDA margin. And maybe if they don't want to give you the full financials, they can at least fill out those metrics and tell you where they're at. Now, there's nothing to prevent them from lying, except the fact that it's fraud. But at a certain point, at least you're able to get something down and documented. And then if they do go into some kind of bankruptcy or liquidity, you can say, look, you said you were fine here, and we need to use that. So again, it's a negotiation like any others. Don't just accept no as that first response, because no should be their first response if they're doing their job right. If that account rep is good at their job, they should say no to this. It's our job to push for it and to create some pain if they don't necessarily do that. So once you've done that and you've kind of done the tables and maybe the sections, now it's sort of a qualitatively, where do we see that level of risk? Again, is it probable, improbable, but then also what's going to be the impact to us? So I would actually start off, if the severity of impact is negligible, I would not even bother doing this type of report for supplier. It's a lot of energy, it's a lot of work. And if there's not going to be any, do I care if Staples goes bankrupt? No, I'll just switch to Office Max or something else. So yeah, would I do it for them? No. Would I do it for my supplier that is either has some proprietary service that they're doing for us or has a highly engineered component that they're doing for us? Definitely. Those are the suppliers you really need to do it for. And then you need to assess kind of, again, on those red, yellow, green tables, how likely is it that we're going to run into an issue with them? So I always say when we do our training, so what? So let's say you have a supplier that it's probable that they're going to go into some kind of financial distress, and it would have a big impact on you if they did. Okay, so part of what we do with risk identification is say, where are those ones that we want to focus on? And hopefully it's, when I say ones, hopefully it's ones. Hopefully it's not dozens or hundreds that you have to focus on. But there are some solutions out there. I'm just going to touch on a few of them because I do think it's interesting. This is definitely more focused on your product or goods type suppliers, so more of your manufacturing. For services, it does, some of these will work as well. But a couple things, obviously you can do pricing and term relief. If you have a supplier that's being hit by a cash crunch and the bank won't lend them money, well, do we pay them, net zero? Do we buy some of their components on consignment? There are some things we can do if we feel that this is just a short-term cash crunch. There's some things we can do as a customer to help them out. Sometimes you also want to prep a second source. Again, whether it's a good or service, if you can develop that secondary source, if you can develop that alternative, and that this particular supplier is at risk, that's definitely something that you want to do. Similarly, a lot of people talk about, well, if I dual sourced or if I dual tooled, but yeah, there's a lot of cost that goes involved with that. But some of your high risk, like if it's really going to be shut the business down and this industry is at risk, that's typically when you want to make those types of investments. A lot of times, and we actually had one client that every time a supplier went into a bankruptcy or distress mode, they would just buy it and insource it. So they had a lot of the capabilities. So every time a supplier went into some sort of bankruptcy, they just bought the tools, bought the equipment, put it over in their facility. You can definitely do that as well. I talked about raw materials and consignment. One of the key things are the bailment agreements. If you have a supplier that has either your tools, your equipment, or your inventory inside their facilities, make sure you have the bailment agreements available. What a bailment agreement is it's just a legal document that says this particular tool, this particular piece of equipment, this particular server is the property of you. And so if they actually get into a true receivership, shut down, close down the business kind of bankruptcy where they're putting a padlock on the door, if you go in with that bailment agreement, you can get the sheriff typically to open it up, get your equipment out of there, and go out. Without your bailment agreement, that's kind of your get my equipment out of jail free card. Without that, you don't have it. So if you have a supplier that is going to be at risk and you have your equipment or something that you own inside, make sure you have those bailment agreements in that file cabinet right at your fingertips. You can look at a supplier asset audit. Again, kind of see the value that they have from assets perspective to make sure, is this worthwhile for us to take it over? Is this something that we should just kind of cut bait and move on? Changing your source or globally source, that's one. Building a parts bank, so essentially receiving inventory before you need it. Again, you can do this for some products, you can't do it for others, but if you can get them to build ahead and you can take receipt of those products, that's something you can do as well. Program rationalization. Is this particular platform, program, service, is it something that we need going forward? Can we replace it by making engineering changes, marketing changes, service level changes? And then supplier mergers. A lot of what happens in the automotive industry is when one supplier goes down, a lot of the OEMs are the ones that are facilitating the merges and saying, hey, we'll work with you, you take over the business, here's the price you're going to pay, because they don't necessarily want to handle those headaches either. All right. Well, I wanted to thank everybody for the time. I'm going to do a 30-second plug on what Cost and Capital does. We actually do a lot of these financial risk assessments. Here's pretty much what our reports look like when we take all of that information together. So again, this is something that we can help you out with as well. You're definitely capable of doing this. It's nothing more than third grade math. It's just a matter of getting the data, running the numbers, and organizing it. That's really the trick behind it. So you don't have to be a financial expert to kind of follow the rules and follow the steps. So yeah, but if you want to outsource it, we do that part as well. And we also do a full, we do both a half day and a full day training on this, typically where we will do a few of the analyses of your suppliers, and then we'll share the results back with you and kind of use this training as how to interpret those results. So what should you do to get started? As I said, some forms of financial distress are obvious, like a vulture looking over the executive. If you're new to financial risk, the first thing is really identify the suppliers that are critical, like which are really the ones that if they burn down tomorrow, you would really be in big trouble. That's kind of a good way of saying these are the most critical ones to us. Send out the financial templates to them, even ask them to just tell you what their key ratios are. A lot of times the suppliers have never really been engaged like this from a lot of their customers. And again, you have every right to ask for it. Risk management is part of your job, and financial risk management, especially in this environment, is something that you're exposed to as well. If you do have an existing risk management program, again, it's probably a little bit more of the reactive type tools, kind of, seeing if their payments have been slowed down, those types of things. This is sort of the opportunity that you can really take a look and maybe zero in on their supplier's liquidity and get a more detailed discussion in terms of what are the actions that they're taking in order to stay financially healthy? What are some of the risks they see on the horizon? What are some of the industries and customers that they're exposed to? So that's typically where what you want to get to is identify the risk, so then you can mitigate the risk. And really those two together are the useful part of doing this together. That said, the appendix has a lot more of the calculations in detail. It has a little bit more of some of the key things to talk about with your suppliers when you're actually talking with them face to face. So I guess at this point, are there any questions? I haven't seen any typed out. So Kathy, I don't know if you've heard anything from anybody, but I would be happy to answer some questions with our remaining time.
Oh, sure. Thank you so much. That was so informative. One question, how should I prioritize which suppliers to target for this type of deep dive?
And that's a great question, because I mean, as I said, this is the high effort, high energy approach to it. So it really has to be the suppliers that if you do have a service disruption, it's going to mean major impacts to you. It means that it's a highly engineered part that's specific to you. That kind of supplier you want to do. We had one of our customers, more on the services side, but it was the one that was processing all of their bank payments and things like that. Again, the cost of the change, it's about a 1 month change to go from one to the other. But if that change isn't prepped or anything, they were identifying, like, that means we're not getting revenue from our customers. That means that's cash not hitting the bank. So it's not only how hard is it to move, but what kind of impact is it going to have on your business if they were to stop operating tomorrow. And again, what I always think about is if the building or if the company caught on fire and they couldn't supply product or service the next day, how bad would it be? If it's really, really bad, those are one of the ones you really want to focus on.
Okay, thank you. Okay, another question just came in. Are privately held suppliers more likely to share internal financial data with a third party like Cost of Capital than a customer?
Great question. I don't know if they're necessarily more willing to or not. I will say that when we do these types of projects, we kind of go hand in hand. So we always start off with having a template for this for our clients and saying, send this to your supplier. Say that this is a board priority, risk management is very important, and kind of outline what some of the consequences are. Now, when I say we get to an 80 to 85% response rate, we're also hounding them constantly. And again, we get to kind of only focus on this. A lot of our clients, they also have their day job to do. They've got to make sure that parts are coming in, that contracts are updated, that POs are issued. We don't have to do that. So we're able to also push really hard on it. So I think if I'm a supplier, sometimes I might be more comfortable with having a third party review it, summarize it, and spit it out. But at the same time, we're sharing the details with our customers. So which are our clients at this point. So I think it should be about the same, whether we do it or whether you do it. It's just we have the time and effort to focus on it, not take no for an answer, and we keep pushing. And every time we push back, we keep trying to escalate it as well. So, but yeah, I do know that most of our clients, when they do it on themselves, do not get to that 80-85% range.
Okay, another question just came in from Rose. What would a typical analysis by your team cost?
So when we do these analyses, a public company is pretty straightforward. We've got the templates, everything fits in. If it's a public company in the US or Europe, we charge $1,000 for one of those, and that's a one-time analysis. And if it's a private supplier, just because there's a lot more back and forth, and we typically then interview the customers or the suppliers, those are $3,000. So, and that's per supplier.
Okay, how long does it typically take to review a supplier?
A private supplier or a public supplier, as long as they have the detail that we need in their analyst reports and the transcripts, typically we can turn one of those around in 1 to 2 days. With our private supplier, I would say it's usually about 2 to 4 weeks, because it's the process of sending out the request, making sure it's getting to either the CFO or the controller, and then when the results come back in, since they're not public finances, we typically have to audit them to see if maybe there were some errors in there. So there can be I would say, 2 to 4 weeks for a private supplier. Not that there's 2 to 4 weeks of activity, but it takes 2 to 4 weeks of time from starting it to when you typically get your responses.
Okay, thank you. And what else have you learned while discussing a supplier's financials?
One of the clients that we did this with, we did it for about, I think it was maybe 80 of their suppliers. And one of the things that he said back to me, he's like, we use this information in our quarterly business reviews with our suppliers. He said it was the deepest conversations we've ever had with the suppliers. We've learned so much more about them. They learned so much more about what's important to us. But you've got some where, again, we had one private supplier and they were talking to us, and again, they were definitely pushing back. So I'm like, okay, well, what can you share? What can't you share? Because they definitely didn't want to give us the whole, 8 quarters of profit and loss, balance sheet, et cetera. So we were kind of going back and forth. I'm like, okay, well, we're a little bit concerned with the EBITDA margin. And he's like, oh, you don't need to worry about EBITDA margin on this particular line of business. Like we're making a good margin on it. Like, which again is probably why they don't typically want to share that information, because every once in a while you find out where maybe they're making a little bit of an excess margin. And another private company that we did the analysis on, their cash and credit available was almost zero. So I was very concerned about that. And they're like, oh, like it's the family, and as long as we all get along together in Thanksgiving and everything's fine, if the company needs more money, we'll put more money into it. So, for them, their source of financing was the rest of the family. Now, did I go in and audit all the family's financials? No, but again, it's the conversations that you want to have with them.
Thank you so much. We're just about out of time, so I want to do a warm thank you to Tom for such an informative presentation. And I also want to thank all of our attendees for joining, and for those who were able to put in a question to get answered. I do want to let everybody know that our next program will be on August 26th, and we will be discussing positioning your supply chain in uncertain times. Again, Tom, thank you for doing this presentation for us. There was so much information out there that is so valuable. And I want to thank all of our attendees as well. And everybody, have a wonderful afternoon, and look for a survey that should be coming out probably in about a half an hour or so. Thank you so much, everybody.
Thank you.